My name's Lewis O'Brien. I've created this 5-minute guide series to property development contracts to help those who want to develop property, be it a small renovation or a large unit development, to avoid common mistakes and do it better. I believe that the ideas we'll offer you here will help you avoid a nasty car crash and help you maximize the profits from your next development. Today we're going to look at GST and the application of the margin scheme. This is an area where I see a lot of confusion amongst my developer clients and an area where mostly we can sort it out fairly quickly. So let's start to explore some of the issues here. Obviously, it goes without saying that GST and tax generally is a huge and complex topic. This 5-minute guide is only intended to provide some simple summaries and is not a substitute for specific and professional legal and/or accounting advice. The information in this video is current as at May 2020. Obviously, there is some scope that the rules will and do change over time. The first question, for those that don't know, is what is the margin scheme? To answer that, I think we need to go back and look at some GST and property fundamentals. First of all, the sale of an existing residential property is input taxed. And what that means in simple terms is that the purchaser doesn't pay GST on the contract price and the vendor is not required to remit any GST to the tax office. However, the sale of all other property by a vendor who is conducting an enterprise is subject to GST, and 1/11th of the sale price needs to be remitted to the tax office as GST. Now, there's a couple of key words here. The first is the concept of an enterprise. Much ink has been spilt on this question of what an enterprise is, but in very simple terms, if you are engaging in a property transaction to make a profit, it's likely you're engaging in an enterprise, need to be registered for GST, and therefore, excluding existing residential property, need to account for GST on the sale. The margin scheme then applies a slightly different alternative. Instead of paying 1/11th of the overall sale price to the tax office, you may, if the margin scheme applies, elect to remit 1/11th of the difference between your sale price and your purchase price as GST to the tax office. All of this might make a bit more sense if we work through an example. Let's assume Bob, who is a developer and therefore conducting an enterprise and needs to be registered for GST, purchases a property for $500,000. He then develops the property and then sells the property for $1,050,000. If the normal GST rules were to apply, Bob would pay 1/11th of the sale price of $1,050,000 as GST. That's a touch over $95,000. Under the margin scheme, we deduct the purchase price of $500,000 from the sale price and end up with a net margin of $550,000. 1/11th of that is $50,000, which is the GST that needs to be remitted to the tax office. Obviously, this is quite a different result. For anyone that's a little excited by the $45,000 GST saving, let's explore fairly carefully when the margin scheme can be used, because I think you'll see that it's more of a corrective measure rather than a tax benefit for developers. So the first requirement to apply the margin scheme is that the sale of the property obviously must be subject to GST. So this isn't something that could be applied to the sale of an existing residential property in most circumstances. The second requirement is that both purchaser and vendor agree that the margin scheme will be applied. In practice, what this means is that the vendor prepares a contract and specifies that the margin scheme will be applied, and then the purchaser signs the contract and agrees to it. The third requirement, and perhaps the most important one, and the one that causes the most confusion, is the requirement that the vendor's original purchase of the property can't have been on a plus GST basis. That is, that the developer's purchase must have been either from a vendor who was not registered for GST or in respect of an existing residential property where that sale was not subject to GST. To reinforce this, let's turn the position around. That is, let's look at when you can't apply the margin scheme as a property developer. Really, the very simple explanation is that if you purchase the property on a plus GST basis, you can't then, when you sell the developed product, apply the margin scheme on the sale. And I think the reason for this really illustrates the point of the margin scheme concession, because if the vendor had purchased the property on a plus GST basis, it's likely they would have claimed an input credit, i.e. a refund from the tax office, in respect of the GST paid on the purchase, and then to apply the margin scheme after getting that refund would effectively amount to a double dipping type benefit. To conclude the 5 points, I just wanted to explore quickly some common misunderstandings that developers often have about the application of the margin scheme. The first is that there's some special trick or set of words that needs to be inserted into their original purchase contract. That's not the case. The only requirement is in the relation to the purchase contract that you buy it either on a GST exempt basis or using the margin scheme itself. The only time you can't apply the margin scheme, as we've seen, is if your purchase price is on a plus GST basis. The second misconception is that somehow GST and the margin scheme is an issue for your accountant to sort out later. That's not the case. I'm dealing with a contract at the moment where a failure to tick a box has resulted in a $200,000 GST problem for the vendor. A similar misunderstanding is the idea that somehow it's the vibe of the thing and it will be all right and we can work out the details later. Sometimes this does work, but it does rely on a lot of goodwill, and it's not a strategy that can be relied on with certainty. It is far better off to get the right advice and to get the GST treatment right at the start. It's also important to note that you can't necessarily rely on estate agents and vendors to give you the right advice about GST, because they're not always free of these misunderstandings themselves. I have, in this 5-minute guide, tried to give you a short and simple overview of the margin scheme for property developers. However, I think it's important to make sure that you either absolutely know what you're doing or have the right advice before you sign either a purchase or a sale contract. In this respect, Lewis O'Brien and Associates have been acting for property developers for more than 20 years, and we'd be more than happy to assist you, even with a small query in relation to your contract. At Lewis O'Brien and Associates, our goal is to make your next development more profitable. We can do this by speeding up the process, by avoiding unnecessary mistakes, and identifying opportunities for incremental gains. I hope you found this video informative and helpful. If you have, please feel free to share it with a friend. Make sure that you don't miss future videos by liking this video and subscribing to our channel, or alternatively, feel free to visit our website at lewisobrien.com.au and subscribe to our newsletter. Thank you for your time, and I hope to speak to you soon.